Good morning, everybody. Welcome to today's morning blast. I'm not feeling very well today. I'm not going to lie to you. You join myself and Mr. Michael Brown. It is Friday, the 9th of January. The first week of January is behind us. I hope we've all made it in one piece. As normal, as is now the regular occurrence on the morning blast, myself and Michael will go over what happened yesterday in markets. We will then have a bit of a rant, bit of a bar side chat about whatever it is that's, perking our interest. And then we'll have a look ahead of what to look forward to today and over the weekend. Just, hopefully add a bit of value to your day, put a smile on your face. Yeah, the usual expletives, warnings and trigger warnings apply. There is no editing whatsoever that goes into this, which regular listeners, will be very aware of. Nothing we discuss is trading or investment advice. Nothing we say is endorsement by PIQ. And yeah, that's it really. I would say, where's Michael Brown? But he doesn't seem to be as a speaker. I can see him in the room, but he hasn't joined as a speaker. I'm not sure what's going on there. Let's see where he is. Did he go out drinking yesterday, perhaps? Let me invite. Maybe Tom, who set up the event, maybe he didn't provide the invite to Michael, but I have done it myself now anyway, so Michael should be able to join, or at least request. Michael can do it himself if he wanted to. We'll see if Michael can work out the technology. In your own time, Michael. There he is.
Hello, is anyone there?
I'm here because I'm the one forwarding.
Very good morning to Ryan. Good morning, everyone else. Tom Wiseman's going under another bus, I think.
Well, in his defence, you can just request to talk yourself as well by hitting one of those big out of the 9 things that people were in the call. You could have done one yourself.
Well, I didn't know I could do that. But anyway, a very good morning to everyone. I'm sorry to hear you're feeling ill, Ryan, but I'm happy to report that I am in much better shape than I was when we last spoke earlier in the week.
Well, this is what's annoying me, because you were really hungover when I was feeling wonderful, and now I'm feeling like shit, and it's not even because of booze. There's just been no upside to it.
Oh, what a shame. My heart bleeds for you.
No, you're a liar.
Yeah, and a bad one at that.
Yeah, very much so. My dear friend, what occurred? I was actually, we had a PIQ strategy day yesterday, so we had the team together. There's a lot of very exciting things coming everyone's way regarding PIQ, which is nice. But what that did mean is I have no fucking clue what happened in markets. So you tell me.
Well, luckily for your sake, not a lot happened in markets yesterday, to be completely honest with you. It was quite a cagey day of trade, all told. Marginally risk averse. The S&P closing flat on the day. The Nasdaq down by about 0.6%. I wouldn't be too concerned about that. I mean, it's hardly sort of end of days type stuff when the Nasdaq trades back to where it was on Tuesday afternoon. And I think it was more a reflection of participants just kind of lacking some conviction ahead of what could be quite a busy Friday. Of course, we've got the December US labour market report due out a little bit later on today, which we'll get on to momentarily. And we also have this potential Supreme Court ruling on the IEPA tariffs as well. So a fair bit of event risk on the horizon, and perhaps no surprise, participants really just not wanting to take on too much by way of additional exposure as we move in towards, as I say, what could be a relatively busy day.
Sorry,
go on.
If I may, just regarding this potential decision regarding the legalities of tariffs and stuff, we did speak about this on, was it Tuesday's show or Wednesday's show? Wednesday's show.
Yes.
Wednesday show. And also Mr. Brown has put out a few good like cheat sheets and stuff like that on it. So do get, well, one, if you haven't listened to Wednesday's show, do listen to that, especially the part on the tariff legality. I'm going to just go have a scan through Michael Brown's Twitter account because he's put on some handy cheat sheet.
Yeah, and obviously we'll cover that later on, so I won't go into that too much now. But we did say quite a lot about that earlier in the week. I would just stress again, though, it's a potential ruling. This is very much every man and his dog putting 2 and 2 together going, the case is pending. The Supreme Court have said they're going to issue some rulings about some cases today. Oh, well, it means it must be on the IEPA stuff. I mean, it might not even happen. It could be next week. We don't know. But everyone is working on the assumption what it's going to be today.
I think the fact that we've been bigging it up and saying, read this, listen to this, it probably means it won't be today.
Yeah, and actually, given that it's the ruling could come out at 3 o'clock on a Friday afternoon, I kind of hope it isn't today, to be completely honest with you. Anyway, we can get on to that in a while. Just in terms of a few other developments from yesterday on the data front, the weekly US jobless claims stats were pretty much bang in line with expectations, although we did have a big surprise on the October trade figures. There was about a 3.5% month-on-month decline in imports during the month, which saw the trade deficit narrow to 29.4 billion, which is the smallest since 2009. Now, we need to be a little bit careful with this because obviously October, government shutdown, etc., etc., etc. But when that number has now been thrown into some of the GDP models, they are producing, frankly, ridiculous estimates of US economic growth. For example, the Atlanta Fed's GDP Now model currently says that the US economy will have grown by 5.4% in the fourth quarter of the year, which is frankly impossible given that you had the government shutdown, which will take about 1.5% off the GDP number. So obviously Trump is running around touting this as some sort of great success, but do take it with a pinch of salt. That will all be revised lower as time goes on. And just speaking of Trump, we did hear a few bits and bobs from him yesterday. He was telling the New York Times that he has a decision in mind in terms of who he's going to pick to succeed Jay Powell as Fed chair, but that he's not spoken about that decision with anybody. Interestingly, we later in the day heard from Treasury Secretary Scott Bessent, who said that there are still 4 candidates in the running to succeed Jay Powell, and that they still haven't got round to interviewing BlackRock's Rick Reeder. In terms of timing, Bessent was saying that that announcement could come after Davos, which I believe is not next week, but the week after. So, I mean, this is just becoming a never-ending saga at this moment in time. And just a couple of other very quick headlines from me. Obviously, you do have the overnight news roundup that Zach has or will soon be putting together.
It's already out there, mate. It's already out.
Oh, it's already out. Very sharp from young Zach this morning. Trump is continuing this affordability drive. He is ordering Fannie Mae and Freddie Mac to purchase $200 billion worth of mortgage-backed securities. This is probably one of the most economically literate things he's actually said in a long time, which is that these purchases will drive mortgage rates down. And yes, they will. In terms of the size of those purchases, the number is not a coincidence because each of Fannie Mae and Freddie Mac have $100 billion before they hit their asset caps, which is why he's chosen this $200 billion figure. It is also, according to people who are much more in tune with the MBS market than me, equivalent to a full year of net supply of mortgage-backed securities in the United States. So although the MBS market is huge, this could actually have a fairly notable impact. And just 2 final stories from me this morning. The first, we had some BOJ sources doing the rounds via Bloomberg earlier on, noting that the Bank of Japan is likely to keep rates on hold this month. They may upgrade their GDP growth outlook, potentially downgrade their inflation view. But again, reiterating that they are likely to continue to raise rates if their economic outlook is realized. And just in M&A news, we spoke about this last year when the story was first doing the rounds, but it's back in the spotlight. Glencore and Rio Tinto have restarted merger talks. The FT broke this story late last night. It was then confirmed very shortly after by Glencore. The way this deal will be structured is as Rio Tinto taking over or acquiring Glencore, and if it goes through, it would create the world's largest mining group. Under UK takeover law, Rio Tinto now have until the 5th of February to make an official binding offer for the company. Glencore popping as much as 11% higher in early London trade this morning. Rio Tinto was down about 4% during the Aussie session earlier on. This is something to obviously keep a close eye, not only from a macro perspective, because obviously mining, materials, industrials are a massive issue at this moment in time from a geopolitical perspective, but also from the perspective of the London market. Glencore is one of the largest listed stocks in London. I think it's the 15th largest stock in the FTSE. And if this merger were to go through, you would very much expect at some point in time that London listing is going to disappear, which is clearly not particularly good news.
Yeah, not good news at all. But I think, like you said, it's definitely on the cards, right? It wouldn't be a surprise to anyone.
No. And I know Rio Tinto have a sort of dual listing structure where they've got a secondary listing in London, but why would they bother with the complications of all that if they don't have to?
Quite. And when you're making your decision about where to list, the reasons for London are like falling off a cliff, really. But there we go.
Well, I mean, it's bad when people would rather list in Australia.
Yeah, well, quite that shambolic exchange as well over there. Cold.
And they have just alienated half my colleagues by saying that.
Reminded of Pepperstone on Australian backed retail broker. I was just thinking of our friend Fatty waking up at 2 a.m. to trade Rio Tinto shares in Kildare. Well, thank you for that, Michael. So obviously, as we've said before, and obviously this week, first week back, we have had a bit of a change to structure of the podcast. Rather than, you reading out headlines, me reading out headlines, you give us an update where we are, and then we just have a little bit of a ramble. So because of that, if you do want to get up to date with all the market moving news headlines, it's even more important, as Michael said earlier, to subscribe to our Overnight News Roundup Substack to get all of that directly sent to your inbox. But in terms of what we're going to chat about today, we've got two things that we can possibly have a little bit of a natter about. One, NFP, obviously, that's the big figure today. And also you put out a really good note this morning about the DOE and how far behind the curve they are. Should we start with the NFP just because it is the big figure of the day and just get it out there?
Yeah, we may as well, and then we can do the BOE in a second. I mean, let me just run through very briefly the expectations in terms of where consensus sits and some leading indicators on that payrolls print. So obviously 1:30 this afternoon, we do get the December US labour market data. That's London time, 8:30 this morning on the east coast of the States. Headline non-farm payrolls set to have risen by 70,000 in the month of December, which would be just a modest increase on the 64,000 that we saw in November. As always, the range of estimates for that payrolls print is very, very wide, between 25,000 to the downside and 155,000 to the upside. And of course, as we discussed, I believe we discussed, I don't really remember it, on Wednesday morning, Fed Chair Powell has previously noted that headline payrolls growth may be overstating job gains by somewhere around 60,000. So in your head, when you get that non-farm payrolls number, take 60 off of it, and you'll probably get to where that figure will end up after all of the revisions.
Which ties me in nicely to a rant we had earlier on in the week, which is why ADP is a lot better than NFP. If we're having to allow already at this stage for how long it is, I'm just saying.
Get your abacus out.
Sorry, I'm just putting it out there.
Right. In terms of things that may affect that payrolls print, there's three things that I just wanted to bring attention to. The first is that the impact of all those Doge-related layoffs that we saw earlier in the year, that is now done and dusted. That would have filtered out as the data come the end of September.
Right. We hope it should have done.
Well, yeah, I'm working on the assumption that it is going to be. Caveats to apply to this. The second factor, again, in terms of government employment, is that there could actually be a significant boost to government payrolls in the month of December. This is because the November report, which as always, and as with the December report, references the employment situation on the 12th of the month, or the week containing the 12th. Well, that came just one day after the government shutdown ended. So there are likely some federal workers who hadn't returned to work by the time of the November report, but will be back at work by the time of the December report. That could obviously boost headline payrolls growth. The potential negative factor to bear in mind is, and it's been all over the news, the US endured some very, very cold weather in December. So those weather-sensitive sectors such as construction could have seen some employment headwinds on the back of that. In terms of other areas of the jobs report, just very briefly, earnings pressures should remain relatively contained at 0.3% on the month and at 3.6% on the year. And then if you look at the household survey, the unemployment rate, that is seen falling to 4.5%, down from the prior 4.6%. Of course, again, the potential for federal workers to impact that number. Labour force participation, meanwhile, that's seen coming down to 62.4%, that from the 62.5% that we saw in November. And just lastly, before we throw this one open to the floor, money markets currently pricing about a 10-15% chance of a 25 basis point Fed cut at the January meeting. And in fact, the OIS curve doesn't fully discount a 25 basis point cut from the Fed until the June meeting. And of course, that June meeting will be the first that is helmed by whoever the new Fed chair turns out to be.
Yeah, no, exactly all of that. Regarding, you did mention about the the caveats surrounding the data quality of this. And I think, again, another reason why ADP is better, in my opinion. But there we go. Obviously, the government shutdown did mess up a lot of this data collection. What's the word? The rate of people completing out these surveys for this is also all-time low, which doesn't help. The survey response rate. Also, we have to be mindful of how disastrous the October official headline data was and how much it was revised in November. And there's a very good chance we're going to get some more. I think it's more important than ever to look at November revisions, because November's data was busy, and we're obviously going to get the first revision of that today. So as I said previously, and it's one of my cliches that I always roll out: headline number for show, revisions for dough, because we might see a nice, an inline print or whatever on the December data, but have one eye on what's going on November, because there's every chance that could be revised down 50,000. So I think it's something we do have to be mindful of.
Yeah, no, absolutely. I think that's the first thing I'd be mindful of. Well, I was going to say, if you're trading payrolls, I will actually give a very rare and unusual bit of trading advice. Don't fucking trade payrolls. I would say very safe. I don't want to speak for Ryan, but I would imagine if either or both of us had the entire data set right now at 9 o'clock in the morning, we would still probably lose money when everyone else got the data at 4:30 this afternoon.
I've given up on the amount of times. Again, another favourite Paisy cliche is that, it's one of those figures where you could tell me exactly what the numbers are before the event and you would still lose money. It's so messy. And, potentially this is an opportunity for a rant or a discussion on another show in the weeks coming ahead, is that difference between fast money and real money.
Yeah, I think we should cover that, actually.
We have done it in passing a few times in the past. I did put out a post about it a long time ago, but it's something that's really worth watching. But I think in terms of what it means for the Fed, my view, Michael, and tell me if I'm wrong here or if you believe I'm wrong here, is that the data, because the government shutdowns and whatnot, and the impact via the Doge cuts and whatnot, and how big the revisions are, I'm reluctant to assume that the Fed are going to give too much credence to this data, especially when Powell's going out, getting thinned out in May. Are they really going to want to kind of jump on the back of their data when the new governor's coming in? What do you think?
Yeah, I think I'd probably make you right on that one. I mean, I think the direction of travel for the Fed funds rate is still very, very clear in terms of it being lower. That's not up for any sort of debate. There are more rate cuts on the horizon. I think you're going to need a significant downside surprise to sort of force them to act at the January mini thing. March is a little bit more of an open question, because by the 18th of March you'll have had another 2 jobs reports, which you'd hope would be sort of cleaner than the messy data that we're getting at the moment. You'll also have had a whole host more in terms of CPI and PCE figures, which again should be a little bit cleaner than the ones that we've got so far. So I think, don't rule out a move in January. If we get something stupid like negative 100k NFP and 4.8 unemployment, then they're going to have to cut.
Yeah, this is exactly what I was going to ask you. I was like, what would it take for this to move the dial? And it's a very, very bad number, basically.
I think it's a significant negative surprise. I mean, I think in terms of nailing on a January cut, it would have to be a significant negative surprise. In terms of making it more of a coin flip, a month-on-month rise in the unemployment rate from that 4.6% that we had in November, that would probably get the doves talking a little bit more, but I think it's a high bar.
Yeah, well, funny enough, you say the employment rate, and again, that's the data that's often overlooked when we have the NFP number, because obviously most people, the tourists just focus on the headline NFP data. But I think that's a good point you've mentioned about the unemployment rate. I do feel like if we do get a 4.7 or above print, I think the dual mandate chatter kicks in. Which the other part, sorry to interrupt, the other part of the payrolls print that often gets overlooked is the breakdown of job gains. And what I mean by that is not necessarily just private and government, but within those private sector jobs, which sectors are they coming from? There was a really good line in a note the other day. I think it was a Wall Street Journal piece. I can't remember who wrote it, so apologies to them. But the line was, a job at McDonald's is probably very different from a job at Morgan Stanley. Yeah. What they were trying to get across by that is, the sectors that those jobs are being created in matters for the broader economy, be that in terms of consumer spending,
changing, be that in terms of how stable that employment could be, and also just in terms of, the broadness of job gains or the narrowness of job gains, because in November, pretty much everything came from the healthcare sector. That tells us a lot as well. Healthcare's the only sector that added jobs in November. The reason it added jobs is because everyone's getting older and everyone gets sick more.
Well,
that's not a particularly bullish sign for the economy at large.
And this is exactly it. And this is an underlying issue with the US as well. They've gone from 20 years ago being a manufacturing country to basically a health insurance country. But again, I'm glad you mentioned about the type of jobs that are measured here, because as we know, and anyone that's read my featured article that I put out on Twitter yesterday, and also my rant on Wednesday, remember, NFP includes government jobs. And if we find that basically all the jobs that were added this month, in December, were government jobs, that tells you that not much is going on in the real economy, or in actual fact, things are very bad in the real economy. So definitely keep an eye on what, the public sector kind of side of the equation, because again, you get 100,000 jobs, but they're all government bods doing fuck all, not really being productive. That's hardly productive for the underlying economy, right?
No, absolutely. The last thing I'll say on payrolls before we move on is just in terms of that sectoral split, before anyone goes, you need a Bloomberg or whatever to get it. No, you don't. Just literally read the press release that the BLS put out on their website. Without wishing to sound too harsh, just don't be lazy and stare at a calendar. Go and do some digging around this. It takes 10 seconds.
I do feel bad because I can't remember his name, but there's one of the guys at Bloomberg very quickly, we always retweet it anyway, but there's a guy at Bloomberg that basically loved his data. And he does.
I think you're talking about Michael McDonough.
Yes,
I think is his name.
That's exactly him. And he does some really good breakdowns within 30 seconds, a minute of the data. So definitely do follow him. Good shout, Michael. Well remembered. Well, look, so let's kind of part NFP now. I know we covered most of that, which is obviously most of today. So that's basically your day ahead sorted. I did want to bring up, because you did put out a really good note this morning, and I'm only saying this so you buy me a beer, but you did put out a really good note this morning on the Bank of England, and basically because of how far behind the curve they are, it increases the chances of a policy error. So if you haven't already, which considering you only put it out an hour ago, people probably haven't read it already, but I've reposted it, Michael's posted it, do give it a read. And to set it up, it's the same story New Year. In the UK, no growth, embedded disinflation, an incredibly rapidly weakening labour market, and yet Bank of England are still divvying and holding. And it's now getting to the point where at some point they're going to have to act, and they're going to have to act sharply. But if they do, when central bankers are back against the wall, that's when errors happen, right?
Yeah, absolutely. I mean, firstly,
can I just say how we haven't had a cut between? I get that they wanted to wait for Rachel Reeves's disastrous budget, so I get why there were no cuts between, say, August and December, but they've got to be cutting now, right? And
I agree. And this is actually a piece firstly, I will settle that bar bill for all the praise you've showered upon me. But this is actually a piece that I meant to write last year, but never quite got round to it because I was out for lunch too often. But having said that, the fundamental backdrop of the UK, as you just summed up there, it is basically an economy that is not growing. The labour market is losing 30,000 jobs a month. Unemployment's at its highest level since COVID, and inflation is now well and truly on its way back towards that 2% target. It's not being driven by statistical quirks or anything like that. It is true disinflationary impulses that are coming through. And you look at the data and it kind of just goes, well, you just need to get to neutral like yesterday. That's how far behind the curve you are. Yet the message coming from the BOE, and actually there's two things here. One is that the governor, Andrew Bailey, said in December, we may slow down the pace of easing. Well, you're already easing once every 6 months. So it's not exactly rapid in the first place.
Well, I would argue they're not actually easing at all at the moment. So how do you slow that down?
Well, quite. And the other issue is if you go through and read the minutes of the December meeting, the comments that people like Hugh Pill and Catherine Mann are making, it's genuinely like they're looking at a different economy to the rest of us. Talking about second round effects and inflation persistence. There can't be any. When workers have effectively no bargaining power at all, private sector earnings growth is about 3.5%, which is what you'd say is compatible with the 2% inflation target. There are no risks of inflation persistence at one moment in time. And as you sort of alluded to a moment ago, when the proverbial hits the fan at some stage, which you would imagine it will at some point this year, they are going to have their backs against the wall, and that potentially necessitates them easing much more rapidly and much more aggressively than they would otherwise want to.
And you know what 9 times out of 10 when that happens is they panic and they cut at a time when they probably should be pausing and even potentially looking to maybe hike coming up.
Absolutely. And then you make another policy mistake.
Well, this is it, right? This is it. They try and be too cautious, and then they end up fucking themselves in the arse anyway. Genuinely, I'm starting to think about the Bank of Japan, because the Bank of Japan should have hiked when they had the chance, they didn't, and now they're hiking when everyone else is kind of going, oh, not sure about that.
Yeah.
Again, I have just reposted your Twitter post about this, because again, the quadrant of doom, right? Give you a guide of how bad things are at the moment. City economic surprise index quadrant. UK is in a really bad situation in terms of where we are sitting at, and we're far away from anyone else, like globally, G10, US, China, EU, etc., Eurozone. Magnitude of downside surprises in economic data is growing, and we're underperforming everyone else. So, please, if anyone's listening from Threadneedle Street, I know it's a bit too late to tell you now, but please cut.
Yeah, absolutely. And a big tip of the hat to our good friend Polemic Payne for giving me the idea for that chart as well. But yeah, we'll obviously speak more about the BOE as we move into, we get GDP numbers next Friday, and then the week after is quite a busy week for UK data. But risks to the outlook already tilt quite firmly to the downside, given what's going on in the Treasury, and the BOE being too tight for too long is only going to compound that. Just lastly, very quickly, because we only got about a minute or so left, I did just want to very briefly cover off the rest of the day ahead.
Yes,
obviously, payrolls is going to be the highlights. Also at 1:30, we do get jobs reports out of Canada, also referencing December. The reason this could be important, obviously, be overshadowed by the US data, but money markets are fully pricing a BOC rate hike by the end of the year. So, of course, the figures that we get from Canada need to be viewed through that lens, and effectively, do they endorse or potentially push back against the case for raising rates by the end of the year? And then the other thing, just to mention very briefly, again, if you want a full rundown on this, go and listen to Wednesday's podcast. But sometime around 3:00 this afternoon, London time, 10:00 this morning on the East Coast, we could get a Supreme Court ruling on these IEEPA tariffs. There will probably be some knee-jerk volatility around that ruling if it does happen today. The two things that I would say is, firstly, if the tariffs are struck down, then there are at least 5 other sections of commerce law to re-establish those very same tariffs.
Yeah.
So you still have that kind of status quo. And secondly, if there are any refunds to be paid, then the process of doing that is going to be somewhere between 6 and 12 months long. And I would wager that by the time that first check actually goes out, by the time the Treasury boost T-bill issuance in order to pay it, every man and his dog will have forgotten about the whole thing anyway. Well, so as we said, pleasing circularity here, as we said about Venezuela at the start of the week, I'll say it about the Supreme Court ruling today. To me, it feels more like a media and a news story than it does a market story.
And what I will say as well, this is going to be one of those things that, yes, everyone gets frothy knickers over whatever this, if we do get an announcement today. But I promise you, this is far from over, and this will be just the start of a massive campaign from Trump against what's going on, and there'll be a lot of fireworks on that front. It's the start of it's the start of the end, not the end of the beginning, or whatever that phrase is. But you know what I mean.
You got that the wrong way around. It's the end of the beginning, not the end of the end.
That's the one. Because we're hitting the limit now. So just one question for you, just going back to the BOE slightly. At the moment, we're only pricing in one cut for 2026, right, for Bank of England? Is that right?
Yes, hang on, let me give me 1 second. So the next 25 basis point cut in April, and then 40 basis points total by year end.
Right, exactly. And we'll see. That's for me. I feel like we could be doing a bit more than that, but we'll see. But Michael, thank you for a great week. It's good to be back on our first week back of 2026. Listeners, again, the feedback's on our new kind of structure, our new format has been very positive. So thank you for that. Keep your feedback coming. Whatever you're doing today, have a great one. Keep it tight. Whatever you're doing this weekend, stay out of trouble. Don't do anything me and Michael wouldn't do. And we'll see you all on Monday. Much love.